So what if I told you that a single, kind of technical rule change from the Reserve Bank of India is about to trigger a massive earthquake in the country's entire banking system? It might sound a little dry, but trust me, this one shift could fundamentally change how we think about the health of our banks. Let's break down what's really going on.
But before we dive in, let me ask you something. What do you think is the single biggest hidden risk that banks face? It's not a stock market crash or wild interest rates. Nope. It's something much more fundamental, something that, if you get it wrong, can bring even the biggest, most powerful banks to their knees.
On the surface, banking seems pretty simple, right? Banks take our deposits, they lend that money out to others at a higher interest rate, and they get to pocket the difference. It's a great business model, as long as those loans actually get paid back. But what happens when they don't? Well, that's where all the trouble begins.
So, here's how we're going to break it all down. First, we'll nail down banking's biggest hidden risk. Then we'll look at the old, too-late way of doing things, before jumping into the new, forward-looking rule. We'll also uncover a pretty big catch in the new system, and the RBI's clever fix for it. And finally, we'll zoom out to see why this all matters in the big picture.
All right, let's jump right into part one, banking's hidden risk. And the main villain of this whole story is, you guessed it, the problem of bad loans.
Okay, so in the banking world, they have a name for these. Non-performing assets, or NPAs for short. These are basically the loans that have gone bad, and the money a bank has to carve out of its profits to cover these potential losses, that's called the credit cost. And believe me, if you're an investor, this is the number you're watching. It's the one thing that truly separates a healthy bank from a disaster waiting to happen.
For the longest time, banks in India have been using a system called the incurred-loss approach to handle these bad loans. But that is all about to change, in a very big way.
So that brings us to part two, the old way. You could honestly just call it the too-late approach. Let's take a look at how this incurred-loss model actually worked.
So check this out. This is how slowly the old system was at spotting a problem. A loan payment could be 30 days late, then 60, then even 90 days late. And guess what? The loan was still considered standard. The bank only had to set aside a teeny-tiny provision. The real alarm bells? They didn't even start ringing until after that 90-day mark, when it was finally officially declared a bad loan, an NPA.
And that right there is the fundamental flaw of the old system. It's completely reactive. It waits for the damage to be done. By the time a loan is flagged as a real problem, the battle might already be over. The system is always looking in the rearview mirror, which is why the phrase too little, too late just describes it perfectly.
So, if that's the problem, what's the fix? Well, let's move on to part three and meet the hero of our story. A new rule that forces banks to actually look ahead. This is the Proactive Expected Credit Loss, or ECL, framework.
And this is a complete 180 in thinking. We are moving from a reactive, backward-looking model that just waits for a disaster to happen to a proactive, forward-looking one that tries to anticipate future losses. It's the difference between trying to drive by staring into your rearview mirror versus actually looking ahead through the windshield. It just makes sense, right?
So, how does this actually work? Instead of waiting for a loan to go bad, banks now have to predict future losses. They use a formula that multiplies three key things. First, the probability of default. What are the chances this specific loan goes bad? Second, the loss given default. If it goes bad, how much money are we actually going to lose? And third, the exposure at default. What's the total amount of the loan we're on the hook for? You put all that together and you get the expected loss.
Under this new system, all loans get sorted into 3 stages, and here is the real game changer. Stage 1. Even for perfectly healthy, on-time loans, banks now have to set aside some money for potential losses over the next 12 months. Now, if the risk on that loan goes up, it moves to Stage 2, and then the bank has to set aside enough money to cover losses for the entire lifetime of that loan, which is a much, much bigger number.
So what does this actually look like in real numbers? Well, the difference is just staggering. Let's take a loan that's 60 days overdue. Under the old model, a bank might have set aside just 0.4% as a provision. But under the new ECL model, that exact same loan requires a provision of around 5%. That's a jump of more than 10 times for the exact same level of risk.
Okay, this all sounds great, right? A stronger, safer system. But it introduces a new kind of problem. And that brings us to part 4, the catch and the fix.
So if this new model is so much smarter, so proactive, and so powerful, where's the potential downside? What's the catch here?
Well, the catch has one name: subjectivity.
See, under this new ECL system, banks get to build their own credit models. They get to use their own assumptions and their own forecasts for the economy. Now, if a bank is being honest and diligent, that's great. They can be more accurate. But it also opens a very dangerous door. A bank that wants to hide its problems could just plug in some super optimistic forecasts to make their expected losses look smaller, which keeps their profits looking artificially high.
And this is where the RBI comes in with a really smart fix. They've built in something called regulatory backstops. Just think of them as a safety net. The RBI is setting minimum provision floors. So even if a bank's own rosy model says their expected loss is only 2%, the RBI can step in and say, nope, the floor is 5%. It's their way of saying, look, you can use your models, but you can't be that optimistic.
All right, let's pull back for our final section and look at the big picture here. Why should you care about some new accounting rule for banks? Why does this matter to you?
First off, let's just talk about the sheer scale of this thing. The estimated one-time hit for the entire banking system to adapt to these new rules is a staggering 60,000 crore rupees. That's the price tag for building much bigger financial cushions across the whole industry, all at once.
And it's really important to get that this isn't just happening in a vacuum. After the shock of the 2008 financial crisis, the whole world kind of woke up and realized the old wait-and-see model was just broken. International standards changed, major economies like the US switched to this forward-looking model years ago. So by doing this now, India is finally getting its banking sector in line with the global standard for safety and stability.
So what does this all mean at the end of the day? Well, for you as a customer, it means your money is in safer, more resilient banks. For investors, it means that data is way more transparent, and you can finally compare an Indian bank to a global one, apples to apples. And for India as a country, it sends a powerful signal to the world that our financial system is robust, modern, and trustworthy.
Now, the RBI gets that this is a huge lift, so they aren't just flipping a switch overnight. They've proposed a start date of April 2027, which gives banks a few years to get their models, their systems, and their capital buffers in order for this new reality.
One thing is absolutely crystal clear. The rules of the banking game in India are changing, and for the better. The goal is a safer, more transparent system for everyone. The only question that remains is, will all the players be able to adapt in time?